good point. So I updated the draft questions to you, Mark. Just sent those. But it's going to be
Okay.
more global. It's going to be more focused on the current environment, whether and the impacts of the trade tariff announcements. So, we'd love to get your thoughts on whether that has impacted you or not and what your current thinking is. So keep your eyes open for Survey 20.
I'm thinking, Bill, we should do Survey 20 here on a Zoom.
That would be
Bill, did you want something before, like now or after Survey 20?
if you have input,
Bill,
send me that.
you wanted to circulate in the chat some of the questions, get some feedback?
Okay.
Which chat, Mark?
We'll put it in this chat here in the Zoom.
Yeah. Okay.
Oh,
It's gonna
I
be a
thought you
long
meant on
one.
WhatsApp. I thought you meant on WhatsApp. Okay.
Okay. Yeah, I'll tell
Why
you,
not?
I'll put it on WhatsApp because it's a bit lengthy because I've got the list of countries for people to put their
You may
opinion
want to,
on.
or
So I'll
put it
throw it
to
in there.
or Google Doc, either way.
You want to add a WhatsApp group called Survey and this just keeps going? I don't know.
I don't think we need any more WhatsApp group.
Well, yes and no.
Defender, I'm not reading them all, so
Yes and
literally
no.
can't.
What I need to do is keep the main chat free because we have like 800 people.
Yeah.
But
That was my point. That
all right,
was my
I'll do
only
that. I'll do that. Anything else? Hello, Andrew. Hi, Joel. All right.
Mark.
Hi, Tim. All right. Well, sir, Stephen Burke, this is the 260-second briefing from Stephen Burke. I'm gonna yield the floor. Stop sharing.
And I just put into the chat a link for a call the Zoom we're hosting next Tuesday at 1 o'clock Eastern time with Dr. Ed Yardeni, who can help make some more sense out of what's going on in the world today. So let me get started here.
What's the latest from it, Yardeni? What is he saying?
Certainly not comfortable with the tariff approach, but earnings are coming in. Earnings estimates coming in across the board. He's brought in his target for this year, but is still sticking with his S&P 10,000 by 2030. But I think he's around 5,600 right now in the S&P. He thinks yields are going to be bouncing around in this range and could go either way. So it'll be an interesting discussion with Ed, certainly. He actually has a way of saying it and what's going on in the economy in a very plain spoken way and makes it easy to understand and feel good about the problems of the world. So
Yeah.
Today I want to talk about investing in a time of hypervolatility, and uncertainty and volatility are not new features of the market, but today's levels have really been matched. And it's not just in the equities, it's what we're seeing in the bond market, what we're seeing in currencies. And we expect them both to continue to be key characteristics of the environment we're in. I think we've seen in less than 90 days, the radical trade policies of the Trump administration have shaken the world order in a very disorderly manner. And that's leaving policymakers, business owners, consumers, and investors struggling to respond. So I want to talk about the hypervolatility, its impact, and how to invest against this highly unusual backdrop. So the obvious measure of volatility is the VIX. And as you can see, this was pulled on Friday at 9:30 a.m. You saw it spike above 50, pulled back down to 35, bounced back up to 44, and I think today is around 30 again. So these kind of bounces, for perspective, are fairly unusual, and the magnitude is quite high. If you notice the 200-day moving average at 18.5 gives you a sense of just how far away from normal we've been. You're seeing it also in the equities. We had the worst 4-day decline since the 50s, We had the second highest rebound in history. The NASDAQ had, I think, the third biggest rebound, as well as one of the biggest two-day declines in history. So you're seeing the volatility here. What I think is interesting is it's not limited to the US. And a couple of weeks ago, we were talking about how Europe and China were going to be big opportunities because of the programs they have in place. And yet, if you look at the performance numbers for the last month, the US is down 4.04%. The DAX is down almost 9%. And China's Shanghai is down 4.5%. So while they looked like they were going to be big moves up, you've actually seen a big pullback in those areas as well. And I think that speaks to the challenges that the US policies are exporting to the rest of the world, and how we're going to have to deal with that. But really, the bond market was the thing that really set the president to pivot. As you heard for the last week, the president, Scott Bessent, and others in the administration were not as worried about the stock market because they felt that that was really the rich people, but being impacted. But what we're seeing now is behavioral changes, not just from the rich, which actually are 50% of consumer spending, but you're seeing behavioral changes from investors around the world, pulling back from the US in a lot of different ways. And if they pull back too much from the bond market, that actually throws everything for a loop, particularly the goal of the administration to get borrowing costs down to levels that would allow the economy to deal with the debt problems that we have and to offset some of the tariff challenges in the short term. So having this push up in rates is troubling. It caused the president to pivot. And now you're starting to see the reactions from that following through. But we've had massive moves in fixed income over the last 2 weeks, and they're highly unusual beyond the range that we would normally expect. So a little bit of a worrying sign there. What's also troubling about the bond market is it's not quite clear what the driver of this is. There are rumors that it's foreigners pulling back on or selling securities, mainly China selling treasuries. That's a possibility, but it's not very likely. China's already taken their treasury holdings from about 1.3 trillion down to about 760 billion in the last couple of years. To go further at this point, when they don't have a lot of places that they can take the money and put it, would actually hurt their own currencies. So this gets into the currency issues as well. So I think you're seeing some challenges in the short term, but I would step back and say there are very few capital markets around the world that have the depth and maturity of the US capital markets that can handle the volumes of capital flows like the US can. China definitely can. Europe, not as much. And how do they put all the money to work with the issuance that they're going to need for their spending plans? So I think this is a really interesting area that we have to watch. I think there's a combination of forces at play here. One is the bond vigilantes have certainly come back to play. James Carville had a great line when he was advising President Clinton, which was he thought he wanted to come back as an entertainer, as a sports figure, but he really wants to come back as a bond market because you can intimidate anybody. I think we're starting to see some of that play out right now. We haven't really had to care about it because everyone thought the Fed can manipulate it, but the central banks don't have the same room to push the markets around like they did maybe a couple of years ago. So that's another area we have to keep an eye on. So is it slowing demand? Possibly. Is it people concerned about the reliability of the government if you're giving them the money to not play games with it? That's a possibility as well. I think this is more of a reflection of the uncertainty and the interaction of trade and geopolitics coming into play that is actually making it hard for investors to know where you can put your money with a high degree of safety and still get it back. You've seen big moves in the currencies as well. And this is one of the things that really has confounded a lot of investors and prognosticators is that the dollar strength is one of the things that sets the US apart. Wanting to weaken the dollar when your exports are slow and your imports are so high is an unusual approach to investing that people are scratching their heads about. But I think we're going to see more pressures around currencies. And the real issue is, has the US gone too far? I don't think we have yet. But we have to keep in mind part of the volatility that we're going to be experiencing is the fact that when the president pivoted, it was only a 90-day pivot. It's to allow for negotiations. It's not that we've reduced tariffs and come back to very low levels. It's that we've taken some of the froth off the exceptionally high tariffs and now have to deal with a whole reset of prices. So the markets responded in a lot of different ways, but recession odds have spiked in the betting markets, jumping up in a couple days from below 40% to over 60%. If you go around the different betting markets, the odds are pretty similar. I checked this on Friday. I haven't checked the last 2 days, but I don't think anything's gone on that would derail that much. Excuse me, that's me.
Okay. That was me.
No, that's a first for me in 260 of these. So now we have to look at what is the tariff policy and what does it mean going forward, because that's been a big driver of this volatility of uncertainty. And it's really unusual when you look at on the left-hand side, these are partners with a trade deficit, and you've seen the numbers that have been put on there. A bigger head scratcher is when you have partners with a trade surplus that have gotten hit with 10% tariffs like the UK, like Australia, and I believe the UAE. That's a real head scratcher, and it makes it very difficult for people to try and sort through how is the right way to play this going forward and what does it mean. So I think this is why we have 70 countries that are eager to negotiate with the US to avoid these tariffs going on. But they're also not sure what they're negotiating towards. What is the goal that they're trying to solve for that would make the US happy? Because the US seems to keep moving the goalposts. And I think from our perspective at ARS, we would expect when we get closer to June and the 90 days ending, that a lot of the deals will not be in place enough to allow this to be resolved. And we're going to see a punt of some sort in some cases, but also higher tariffs in others, that I think the combination will create another round of volatility for the markets to deal with. So, and you'll continue to see these big single day moves in individual companies and individual sectors of the economy. And it's still not clear what the end game is. So I think these are the factors that will keep volatility elevated and uncertainty high. But the big issue for me is where do we go from here with China? And I think the way that China's played this is actually really interesting and a sign that they've taken lessons from Trump's first go around as president, and also how he's dealt with the Democratic Party and how he got elected. He was using phrases that were his ability to use power of persuasion to identify characteristics about a group or a person that put them in a bad light, which worked when you're dealing with politics. It works less well when you're going after nations and nationalities, like calling Canada the 51st state, questioning Greenland's independence and saying that should be the US. Those types of things don't work as well in geopolitics as they might in domestic politics. Because you expect people to go after your rivals in an election campaign. You don't expect to go after allies in normal foreign relations. So I think the issue has gotten to be, that's where we've gotten to very unusual levels. I think it got so far that China actually came out and said, it's now a joke at these tariff levels. We're not going to retaliate because nobody will buy anything at these levels anyway. And I think they've taken a lesson from Trump not to engage him and react to his provocations, ignore them, and respond in a more measured way. It's more frustrating for him not to get the reaction to get the reaction. So I think where we go from here with China is really the determination for how tariffs will play out. It also is a reflection of the focus of Bessent and the administration to target the UK, Japan, Australia and Korea for the early discussions so that they can get a win in Europe and get a win in Asia where you're ring fencing around China. Failure to do that gives China greater leverage. So I think this is really one of the things we have to see play out. I think China's playing this in a smart way with whether they have a weak hand, as Scott Bessent's referenced, or the US has a weak hand. I think we're both not playing from the strength we'd like to see us playing from. But one of the fallouts from all this is very dangerous for politicians, which is cost of living's going to go up, whether it's transitory, as Waller said, which in theory tariffs should be transitory because you have the tariff set, you have an adjustment to the price, and then you move forward. However, if we don't have a final tariff and we keep adding on and ratcheting it up, then you'll have inflation and higher cost of living that continuously get reset. So the question is, do we get to a place where we have a one-time cost of living increase, the world can adjust and we move forward or not? We're not sure yet. And I think that's the problem with investing today. It's the problem for businesses today. It's the problem for consumers is the uncertainty is so high, you can't make good decisions to move forward. But these are some of the products that right now you're going to see pretty healthy tariff increases for. And then how does he respond to that with exemptions for it is going to be where you're going to have hypervolatility. The other question is what happens if foreign nations turn to service revenue that the U.S. does exceptionally well on as a target area for retaliation? Here are some of the companies that by revenue exposure could be most impacted. It hasn't been the place that people have gone to yet. You're starting to see them go after some of the treasured companies in the U.S. like Boeing, where China announced maybe not taking orders on Boeing planes. We're not sure that's as big a deal because there's high demand for those planes. You can shift the demand to other places. And similar to China locking out US with some of their tariffs on rare earths and other things, not allowing China to get the parts to repair the planes makes their current inventory less valuable and less operable. So I think we have to see how this plays out, but keep an eye on the services area. So how do you manage through this period? I think for us, we think about a couple of things that trade policy has damaged our credibility with the rest of the world in the short term. Will it damage it for the long term? Depends on the outcome of these negotiations and how far I believe the administration pushes to move forward and what crises come up out of this. Are they crises generated by the US, like a financial blowup? There were concerns about that in the bond market and perhaps the basis trade leading to another long-term capital management type problem. But I think we have to just see where it goes here. But for our case, we also are worried about the demand for the dollar declining. If the U.S. reduces its trade and its deficits so much, there'll be less need for dollars. And that will go against the U.S. exceptionalism. I think right now, the other thing to keep in mind is CEOs and street analysts can't forecast earnings because nobody knows how to come up with the E. And you're starting to see a couple of companies pulling back on their guidance for the quarter. How long does that go? We have to see. But it's very difficult to figure out what the earnings are going to be. Therefore, it's hard to get price earnings and figure out where you're going. So I think that's one of the things that you have to keep an eye on. I think the other thing that's really important to remember is there's going to be a timing mismatch between the short-term pain and the longer-term benefits that the administration sees as their desired outcomes from their tariff approach. One of those areas is going to be skilled labor. So while there's a lot of focus on is unemployment going to rise a lot, it may, but one of the areas that you won't see it rise is in areas that there are skills mismatches right now, as companies are worried that they won't be able to replace laid off workers, and that some of the other areas we're seeing will create mismatches there. You're seeing a mismatch in the bond market with supply and demand and questions. The 3-year auction didn't have great bid to cover from indirect participants where the 10 and the 30 did. We're going to see swings like that are going to make it very difficult for projecting where we're going to go. I think the other thing we have to keep in mind is protectionist policies reduce productivity. And this is a big deal in the environment that we're in. And there's so much spend going to increasing productivity that you're going to counter the benefits of that with protectionist policies that make it very difficult to combat some of the increased costs that are coming with the higher cost of living. But I think these features will be hypervolatility and uncertainty will be defining features of the environment for the next 2 quarters and maybe beyond. And we just have to see how far do they go before they pull it back. I think central banks are in a tough spot right now to step in because if they step in too aggressively in cutting rates, they could spur the inflation that they're trying to avoid. And at the same time, if they're too slow, they could create a recession by not stepping up. So it puts them in a very difficult spot. The other thing to keep in mind right now is that the high-end consumer has been, which is basically boomers are about 50% of the 165 trillion of consumer net worth in the US. The 6 trillion pullback that we've seen in the markets has concerned them somewhat. If they pull back their spending, that actually takes one of the legs that has pushed the US forward through some of the uncertainty of the last couple of years and pulls that spending back. If the federal government tries to push too much spending to the states, and the states have balanced budgets and increased needs in other areas to deal with their own problems, that's going to create a slowdown that there's just not enough capital to go around. And therefore, the private sector would have to step up, and can corporations continue to spend with confidence if they don't believe they're going to get the return in this environment. So I think these are the things that are creating the uncertainty and the hypervolatility. So for us in these environments, you invest in the areas of required spending. That's in the reindustrialization that's going on. Reshoring has slowed for the last 2 years. We've talked about, Mark, one of the big themes for the last 5 years was the Midwest being the best emerging market in the world. And we think that's going to start up again. But for the last 2 years, it's been slowed down. I think you'll see that pick up. There is a lot of deals being cut for capital to flow to the US. But we had this with China back in 2018, and the deal was made. Everyone was excited, but not a lot of capital came in behind it. So I think we have to be careful about that. But we think reindustrialization is real. The electrification, the power needs of the global economy and the US economy are going to continue to be as high as they've ever been and growing at a pretty alarming rate. I think the need to counter the higher costs with more digitalization, more innovation, more AI is real and is going to continue. It'll change in the spend, and I think we'll see in the realizations on some of the private deals being lengthened out. Does that slow the investment into this area? What changes there? How do we play that? I think that's going to be one of the challenges. But I think you have to keep in mind that I did a back of the envelope calculation. I think the Magnificent Seven has about $500 to $700 billion of free cash flow projected for this year. Just think about the scale of that. That would be larger than, I think it's about the size of the DAX, entire market cap of the DAX. So for perspective, the free cash flow this year, which allows them to pull back spending, defer spending, and deal with the existing acquisitions that they've made and still increase productivity is actually pretty phenomenal. So don't lose sight of that with all the negativity, and the pullback in those names have them selling at much more attractive valuations than we've seen in some time. So I think you will see a reversal where capital will start to flow into some of the beaten down names. Healthcare and financials are two other areas that will continue to push forward, but they're getting whipsawed around by the policy uncertainty right now too. But I think those are the areas that will benefit over a reasonable period of time. And required spending is going to be where money will flow, and discretionary spending will see pullbacks. So I think those are some of the things you want to keep in mind as you're investing in this period. I do think that bottoming is a process. We heard from John Najarian and Mark Lopresti last week where they thought seemed like we were at a green light and everything was a go. If you have a trading mindset, they're probably right. There are trading opportunities. From a more long-term investment mindset, I think I would go more measured, but we are nibbling around the opportunities that are being presented in some of our favorite names and favorite areas to invest. So Mark, I'll stop there and open up for a discussion.
Thanks, Stephen. Questions, comments, everyone?
They're as confused as I am. Or-
Hey,
Yes, Anthony.
hi. Hello, can you see me?
Yes, we can't see you, but we can hear you. You have a question?
Hi. Yeah, I'm in London. Steve, so what do you think about my Ray Mental call? Should it be sold now? It's at a new all-time high today. When I first mentioned it, what was it, in March? It was in the 1200s. It's over 1400 right now. Through this whole debacle, it has defied gravity literally, and it's moved since the start of call it the war, being the supplier of tanks and shells from what, 200 euros a share to about 1450. At the same time, gold has moved. My question is, should we be all into European defense, including Ray Mental, which was doing a walking tour to take over the VW factories that are redundant in Germany, and gold, physical and the related miners, depending on one's choice, of which and what market cap. And or is it too late for those that haven't participated? And what is it telling us that in this time of absolute uncertainty and turbulence, volatility, that these stocks are acting like growth momentum Mag 7 in their prime, meaning the collective European defense thing, which actually was mentioned by you way back
Anthony,
in one of your meetings. That's my question.
Okay, thank you.
I don't have the answer to should you sell the German defense company or what right now. What I would tell you is the way we're seeing the market, when you're getting gifts in the short term in your favorite areas, I would take some money off the table, but not destroy the position. You're having major moves in single days, and one of our favorite investments was up 22% yesterday. It should do well for the long term. It's an absolutely essential area for all technologies, but a 22% move in one day, it does is you're getting a gift, take the gift. It don't destroy the position though. So I think you have to look at it on your overall portfolio and how you feel about the position. On gold, I would say that different than other times right now, the dollar being under pressure the way it is and the lack of confidence in the US investment policies, I think will have gold continue to be a more attractive area for investors. And I think that the thing I would watch there is central banks have been big buyers of it. If they start to slow their buying and start to redirect, I would think that there may be a time to pull back from that area. And then I think in general, I think that Europe, you have to see after the initial enthusiasm that they had, you have to see if they can follow through and get their act together to get the collective strength of Europe to support the industries and individual companies without a problem. So I'll stop there on that.
Jonathan, then Bill, then Joel.
Thank you. Thank you, Stephen.
You're welcome, Anthony.
Thanks, Mark. Stephen, always a great presentation. I really appreciate you.
Thank you.
We haven't been talking about BRICS very much. With the US being so belligerent internationally, do you think this is going to allow BRICS to heal some of the fissures that they have? And if yes, what does that mean to energy markets and the US as the reserve currency, the dollar as the reserve currency?
I think the answer is yes for some and no for others, and it'll depend on Like, I'm not sure that India and China necessarily move closer together as a result of this. I think that you might see China and Brazil, for example, move closer together. But I think you really have to see how the dance cards set up with the U.S. If the U.S. loses, if the U.S. goes too far with the policies, then it will impact the dollar. But I don't believe that the dollar is at risk yet, because I don't see an alternative to it. I think you'll more likely see currency, more swaps set up that allow people to slowly move away from the dollar. But I don't think the dollar currency is going to be the problem in the near term.
Thank you.
You're welcome. Bill?
Cool. Steve, this is the chart that you had, the bubble chart on the trade deficits was really interesting. And I just looked at it, and our trade deficit has been consistently above 500 billion since early 2000. And one can perhaps think about that as like annual FDI. And I just wonder if we sort of execute on this strategy by Trump, which would be to cut that deficit, that means there's less money going into our trading partners. I'll just leave it open-ended. You got any thoughts on that one? I mean, that to me sounds like contraction.
Yeah, I think the outcome from this, and I think it goes to Anthony's question a little bit, is this trade war should have no winners coming out of it. It's very difficult for any country to win in this because costs are going up, the system is being disrupted, and this was 75 years built by the US primarily, and if you rejigger it too much, you'll blow up the system and everyone will lose. So I think you're right on that. And I think that's where the gamesmanship of the administration, I have to really be careful about going too far. And I think you have to hope that the adults in the room continue to be the adults in the room and that they don't get pushed to the side, which they did in the last administration. But it is really hard to see the policies getting to policy clarity when in one moment you have Bessent saying one thing and then Commerce Secretary Ludnick comes out with something else right after. That's in contrast to that. Hard to see how you get policies that are going to work right and get trade deals done in that environment to work. So I think you're right, Bill. I think this is not ideal policy. The outcome may be, the goals are well intended. I just think the approach could have been done with a different sense.
So Joel and Leslie and Andy.
Yeah, thanks, Stephen. I'm just wondering, I look back at DeepSeek and how we kind of created constraints in the tech sector for China, and they kind of out-innovated us in AI. And I'm just wondering, are we creating constraints for China that is going to make them continue to innovate even more so and lap us essentially? And then that, minus Magnificent Seven, how healthy are our markets? Those are kind of my two questions. I just feel like the more that we try to take the approach we're taking, the opposite tends to happen.
And actually, if I can add to that, this is what happened in Russia, because there were actually sanctions a lot by Europe and US, and they started developing a lot of things internally. And now actually, I can see it's a much safer environment, that they rely more domestically or more Russia versus Asia flows. So wondering whether this may not happen, just to add to your point.
I think in the short term, it absolutely does push them to do that. Long term, if you go that route, then we become less innovative, we'll have less growth, and I think everyone will be worse off. So I think the concept, Joel and Alec, that you're highlighting is right. And I think this is the negotiation game that the administration's playing. If they go too far, they could really blow it. So I think you're on the right track there.
Leslie?
Yes, hi. Thanks very much for that. I have to say that's one of my concerns as well with ring fencing China is it could make them more innovative or strike back. What's your view? Because they do seem to be negotiating the tariffs really as trade policies, which include excluding China or taking an equally tough stance on China.
Yeah, I think this is really, I think it's hard to know what the end game is because I'm not sure everyone's clear on what the goal of tariffs is today. It seems to be moving around. Is it fentanyl? Is it rebalancing trade? Is it correcting unfair trade practices? Is it intellectual property protection? What are we really trying to solve for is unclear. I think China and the US, I think we both need each other over the long term. I think the world needs a healthy China and a healthy US, and I think we have to figure it out. This would not be the policy approach I would take. But I'm not in office for good reasons. So I think you're onto something. I think that if we go too far, this is going to blow up. But not just the US, this will blow up the global economy.
Andrew?
Thank you.
Yeah, going back to what Bill said about trade deficits since 2000, I don't have it handy. I saw an interesting chart where somebody had put the trade deficits of US, Europe, Japan, and China along with the growth rates since 2000. And the US growth rate outstrips everyone. It's growth rate per capita. So that's why China's not as lower in the US. And so back to Stephen is the list that you just made of all these things that we're not sure what we're trying to get.
Yeah.
Aren't most of them really long-term sort of propositions that you redo your tariffs and then you have to slowly sort of reshore or trade these things because the global economy is not set up to build and sell things this way. And I'll leave it with one statistic. This is current, is 14% of scheduled shippings from China to the US have been canceled. Now you might get a couple on a normal basis. That's a huge number. So it's already beginning. And then, and Stephen, you and I were talking about Boeing. There's 1 million parts in an airplane made in Malaysia and all over the planet. There's almost no way to like make one. Even the middle of an Airbus A350 is made in North Carolina. So isn't this a really long-term situation? And are we cutting, throwing the baby out with the bathwater by trying to do it quickly, or maybe quickly is the way to do it? I don't know. What do you think?
I think the administration had a view that past administrations, including their own, tried to do the traditional approach of negotiation and even pushing a little bit further with tariffs, but didn't get the response. So I think they went with shock and awe. I actually think this is really still all about trying to neutralize China. So I don't know that, I don't really understand the approach, to be honest with you. I don't think it's necessarily great policy, but I get
I was asking just so I don't have to drag you on it. I was just asking about what you think the results might be of short-term shock and awe versus a very slow sort of progressive,
I actually think it's going to slow growth and raise inflation, and we'll have to deal with that, and all the countries will adjust. I think the biggest issue is it's going to make it very hard for corporations to invest because what are you investing for? which policies are you trying to address to counter? I think it makes it very difficult. So I think the first big shock is going to be the inability of companies to pursue long-term spending plans in the short term. And that will have an impact throughout the system.
I was just thinking of somebody to actually stick up for Trump. I was watching LaPresti yesterday on CNN. Not that he's got his own view apart from Trump, but I think he's gonna join. Just so we get all the perspectives.
Yeah, I think the idea, the policies are.
I mean, like Ray Dalio is if he were to he was sort of like, let's see how things play out. He saw some justifications for some of this, and it's just the speed and haphazard manner. But to your point, some were saying, could it be otherwise? So.
Yeah, I don't think it's the end of the world, by the way. I know it feels like it in certain days here, but I think this is, I think the global system has dealt with setbacks throughout. I think the issue, this one versus all the others, this is self-inflicted. This is a policy decision to disrupt global trade and to hopefully have it better in the US when you're all said and done.
Anthony, Joel, since you've spoken already, maybe let's let Paul have a word for a second. Paul Menjung.
Thanks. Hey, Stephen. Hey, Mark. Yeah, I guess the question I had was with all this, slowing of trade, where are we going to be with financing the U.S. debt? I guess the first question is, it seems that the debt, the $9 trillion that we have to roll over this year, is maybe going to have to get focused on short duration debt. So I wanted to get Stephen's view of where do you think the yield curve is going to look in 12 months, and do we have a chance to, are there? I view that there are other takeouts, including stable coins and primarily stable coins as potential other purchases of U.S. debt. But I just wanted to get Stephen's view on how you see this slowdown in global trade affecting where our yield curve is going to go. And then is Bessent forced to do short-term, to roll into short-term debt, or can he do, more general, raising across maturities? It's not clear how previously I think Yellen was kind of focused on the short term, even though she said she wasn't. But now it seems that they're trying to get more into a regular schedule, but they may not be able to.
Yeah, I think that's a key issue that they're trying to figure out is how do you, if you keep rolling over short-term debt and you roll it enough and you end up with higher rates on the long end, you're actually going to increase your interest cost and net interest cost and make your problem worse. I think this is one of the things that they're trying to figure out how to play. And I think the uncertainty around where the best place to be on the yield curve is gets to, you're not sure where, if you're concerned about other nations dumping debt, how do you play that? And if you're not sure that there will be enough buyers that are going to, that when you buy a piece of debt and that you start to see rates go up, if you can't hold to maturity, what are you going to do? So I think they're going to continue to finance on the short end because they have to. They'll try and figure out a way to lengthen it out. And part of the negotiations with other countries may be like Japan and some of the partners that are coming to the table right now, may be that they will be purchasing debt that allows us to put the maturities out a little bit further as part of what they're doing. I think that might be part of what their negotiation strategy is, but you don't know until you see it. But it is an issue, Paul, and it's one that people are going to be focused on. It's not clear what the end game is.
Yeah. Thank you.
Your question seems to be a plug for our Survey 20. It's coming out soon. Again, new voice, Sandy Voss, real quick.
Thanks, Stephen and Mark. And Lara, am I pronouncing that right?
No,
Lara.
Lara, sorry, no offense meant. On the subject of rare earths, Stephen, where are we going to make up for this potentially big shortfall in rare earths? And I can't help but wonder if the likes of the topic of Greenland and other countries, if that's not part of the strategy. And
it absolutely is. It's the strategy with Ukraine. It's the strategy with Greenland. It's the strategy with Canada and the Arctic. Rare earths are a big issue. The question is the counter question to if China chokes off availability of critical materials, does the West figure out ways to work around it as well? Right? Every time we create problems, the innovative nature around the world, we kind of figure out a solution to it if we can. In the near term, I think this is part of the case where the US and China need each other. China needs needs factories to provide low-cost labor to take care of their population. The US needs people to produce low-cost stuff because we don't have people who want to do it. There was an interesting discussion in the first administration between Gary Cohn and President Trump on, why are you so big on bring manufacturing back to the US? And he says it's good for the country. And he said, who's going to do the work? And I think that is a fair question. Who's going to do the work in the factories? And we haven't answered that question yet. And if it's robotics, that doesn't help the middle class. So I think that is a big issue. And robotics is a great answer for the factories. It's not a great answer for the economy necessarily, unless you find other jobs for the people that would have worked there to begin with. So I think this is part of the dilemma that and Tom Friedman has a great line he uses a lot when you see bad policy decisions made, is, and then what? And we don't always ask the "and what" question. And I think that's the one that you have to ask on your question. And then what happens? And I think that we're starting to find a lot of the and what's, and we don't have good answers for them. And it's not just here, it's around the world.
So Anthony, back to you, and then Joel. Yep.
I think that credit markets, the world, credit currency, and what are we going to do about the 9 trillion and then the impact of less fascination with US debt?
On the 9 trillion, I actually think that
we discussed this.
Anthony, you're coming in and out. So Anthony, you're coming in and out.
Sorry.
Yeah,
what I'm saying is, can we just focus on that for a minute? What
9 trillion?
Yeah, the 9 trillion, and can we just look at what if it was really bad, meaning that less fascination with US debt and causing yields to rise as opposed to fall, and what that would mean. In other words, what you were saying earlier, how do you avoid a global financial catastrophe, which would come first and then economic, and how, in other words, how do you avoid that tipping point, and what will wake them up to the fact that they're playing with fire? That's what I'm asking. Sometimes what's obvious and imminent, and people think, it's right in your face, nothing will happen. It happens. It does happen, right? And so it's hard to imagine.
All right.
Thank you. Clear. Bob, ready. Thank you.
I think that the people will buy the debt. I think we saw it. If I looked at some of the central bank numbers, and while I mentioned China's come down, Japan has actually not come down that much recently. And you've seen flows coming in from other countries because the US is still a place to put capital where you can put it with a greater degree of confidence, maybe not the same degree that you had in the past. So I think that we will see continued buying. If you don't, the Fed will step in first. And if the Fed can't do it on their own, you'll see others then partner with other central banks to stabilize the system, because that would not be a US problem. The problem would go well beyond.
Joel, you've been patient.
Yeah, I wanted to ask, and I put my question in the chat as well, you know, being Gen X, looking at my kids, looking at Gen Z and Gen Alpha, looking at the young person in our chat here. What is this skilled labor that we speak of? How can young people plan for their futures in this kind of environment that is so freaking topsy-turvy? And I'm just trying to put myself in the mind of a 20-year-old right now. And I guess I'm kind of asking you, Stephen, but the whole group. What should young people be focused on to prepare for their future in this kind of environment?
We think a lot about that. We think a lot about that at our firm, as what is the right answer. And I think we actually have to teach them how to learn. I think I think it was John Paul Getty who said the illiterate of the future are not those that cannot read nor write, but those that cannot learn, unlearn, and relearn. And I think that we're in that mode right now. I don't think teaching them individual skills is the one thing. I think you teach them life skills. I don't think teaching them a single vocation is necessarily the way to go, because we've seen those things get wiped out pretty fast.
So Gen Alpha wants to answer the question.
Perfect.
Stand up.
Well, to plan for the future, you have to pay attention to things that like you could think that they're boring, but you have to pay attention because you never know, it could be your future or someone else's.
What do you think about your older sister who's 20? How is she planning her future?
Well, I think she's planning her future by doing things that she doesn't want to do, but will help her future.
So the same answer. Okay. Over to Adam Blanco. Oh, wait, she has a question for them? For everybody?
Yeah.
Okay, question from Gen Alpha.
How did all of you guys figure out that you really wanted to do this?
What you're doing. I'm not sure what this is yet, but
like, how did you guys know you wanted what is this job?
yeah, what you do for a living, you know.
How did you guys figure out why?
That is a longer, just like your joke, your 5-minute joke. That's not a short answer.
Well, I have a question. Actually, I have a question for her, because I ask this question at events all the time.
Okay.
Very interesting how your kind of what you do or did as a child does end up being your career. Like I did a real estate one recently, and I asked what their favorite toy was in December, and almost everybody had erector sets. Interesting, right? So what do you want to be when you get to that age, and what do you think you'll end up doing?
What do you want to be?
I want to be like a famous actor, a famous dancer. I just want to go on a red carpet because, paparazzi, come to me.
Fabulous. I'm wishing you all the best.
Yeah.
Paparazzi over here.
But you also, but we just did parent teacher. What about your writing and reading?
One of my accomplishments, one of my goals I really want is to write a book.
There you go.
About.
Well, maybe after you're a famous actress, you'll be writing and directing.
Oh yeah, I also really, really want to direct it.
See, she's on her way.
There you go.
Good luck.
All right, let's keep it going. Adam Blanco.
Oh my gosh.
Oh, wait, sorry. You just asked that question. You asked what everybody wanted to be. And how did they figure it out?
Oh yeah.
I guess Erica answered it with a question. But we're going to keep it going. 361 style. Here, Laura.
Stephen,
Adam.
thank you for the presentation. Stagflation or recession? What are the probabilities? What are you looking at? What do you think? What is your view?
I think we have stagflation now, and I think we may be in a recession now, but won't know it for a little while. I think the odds are rising, but I don't think it's going to be a particularly steep one, because I think you've seen Trump will react to off ramps that he's given to say he saved the day somehow. So I think he'll find an off ramp that'll stop a full blown recession or a deep one. I also think the Fed over the last year raising rates up from the levels that we're at has given them some bandwidth to act not only on rates, but also on quantitative easing. If they needed to do QE again, they took it down from $8+ trillion to 6 and change. So I think that'll allow it to move forward to counter it if they needed to some degree.
Thank you, Steve.
Jeff Sawatsky, then Wilmot.
Thank you. I was just curious on your thoughts, Stephen, on this attack on higher education and research, just from the standpoint of the longer term impacts, maybe even the tariffs. Because if you think about our hallmarks as a country, it's really been the reliability, stability, and then our strength in higher education research that drives our innovation and growth. Both those two things are under severe attack, and doesn't that position China to be kind of more of a more reliable global partner in the long term? Thank you.
Yeah, I think I don't think our education system's actually nailed it. Let me start with that. If you look from, you're talking about higher education, but K through 12.
Talking specifically about higher end education, and which draws the best and brightest around the world. They still come here. That's what drives our growth. That's what drives innovation. I'm not talking about K to 12.
Yeah, I think there's a middle ground between the administration's attacks on them and the behaviors of the universities to provide better education. I think there's a balance there, but I think in the terms of the science, I think that is one of the areas that we need to be very thoughtful and careful on. And I think this is a setback. My brother's has a PhD in pharmacology and an MD, and has been a teaching doctor for most of his life, and definitely has strong feelings on what this could do to our healthcare system, what it will do to our innovation across the board. So I think we have to be careful there. But I also think some of this is, those universities maybe lost their way a little bit too. So I think it's about meeting in the middle. I think the administration's a little too heavy-handed on this. I think the universities need to do a better job as well.
Wilmot?
Hi, everyone. Sorry I joined late. I'm just curious as to your thinking about the likelihood that China's leveraging of the BRICS membership increasing over the last few years, what that means for international trade for them and for that alignment of countries vis-a-vis the U.S. Because so right now we've seen bilateral sort of responses to the tariff wars, but seemingly that could change where there is a more of a regional and networked approach.
Can I pull an Erica on you, Wilmot? Can I answer your question with a question? What do you, you're in Africa, what are you seeing firsthand?
Yeah, we see China increasingly deepening its relationship with African countries, investing less money in infrastructure and lending less, but there is more of, I guess, alliance building with the other BRIC nations and African nations, and more of, I think, of a sense that there is an opportunity now to support the membership economically without the US's involvement. As you would be surprised, particularly in places like South Africa, there is that strong sentiment, which is increasing its ties with Russia. So I think we're looking at sort of that regional configuration becoming stronger. But that's my opinion just from this global South perspective?
I think that's clearly the goal. I think the challenge that China's going to have right now is the imbalance in their economy has them having to send their excess capacity around the world. And if it's not coming to the US and Europe's catching on to, they don't want the excess capacity dumped there. And the excess capacity will go to the global South. And that'll be great initially because they'll get all this low cost stuff. But how do they get their economies turned around on that? And does it really raise the living standards for them over time or not? I think is one of the challenges. So I don't think it's necessarily good or bad. I think it's just going to play out as something that actually each country will react differently to it. And how does it impact their labor force and all that? Because when China comes in, a lot of those good jobs go to Chinese nationals, and then you have some fallout from that. And other countries have had different experiences with the Belt and Road that might have reflected similarly to what their reactions were from the US.
Thank you.
Wanda?
Thank you. Stephen, my question is about you using administration as a collective term for policy making. My question is, how do you separate noise from the real signals? Who is behind the term administration? Who do you listen to and try to figure out the real leverage? And the variation on this question is, does business in today's policymaking has any leverage? In your opinion, where are the CEOs? Are their voices being heard? Obviously, on the stop on the tariffs, as we talk, it was more of a bonds rather than the stock market. So again, where's the leverage? But primarily, who do you listen to and who you just forget about, whatever the comments are?
I would say I listed a chart about a month ago, which was the policies of the RNC from last year, which is actually the same policies that are listed on the website of the White House. It's 20 priority issues, and those are that is the roadmap the administration's followed. So I would say it starts with the president, and that would be the one that you have to listen to. That's what those policies are. He's believed in tariffs. He's said he believes in them, and people didn't believe that he believed in them as much as he's done. I think after that, Ludnick and Navarro seem to have been somewhat backbenched for the near term, and Scott Bessent's taken the lead on the negotiations. So I think the turmoil in the markets from the last week, as well as the comments from Larry Fink, Jamie Dimon, and others, actually did impact the White House's views. I also thought it was interesting that Tim Cook was very quiet throughout the whole thing. And lo and behold, you have some of his issues exempted.
Temporarily.
Yeah, temporarily. Again, everything's 90 days. So I think right now, the president has to see how the negotiations go with the 70 nations. And if they go badly, all bets are off. If they go okay, then we'll be fine. And if they go well, which I'm not sure how that's defined, I think then the market will move forward. But I think for right now, it would be Bessent and the president. Actually, even Bessent today was saying that they're start the process for the new Fed chair. That was announced by Bessent, not by the president. So that gives you a bit of a sense of how he's moved up in standing. But the other thing I would say, keep in mind is being a favored child in this administration can be very fleeting. Navarro and Ludnick were very popular early on and seem to have been pushed to the back. You also had Lighthizer from the first administration was pushed to the side as well because he was viewed as not aggressive enough. And then Navarro was very vocal about it as well. So I think that's kind of how I think about it for now.
So hold the thought, David. I think I saw Mark Lepresti join. Mark, are you on? Just that. I just want someone to represent a sort of bullish case. This is see how he feels. Let's give it a second. David, go ahead. Did I scare you off too? David Lane?
Yeah, my concern is the way that that everybody perceives the United States with everything that's going on. I mean, that's going to have a lasting effect on a lot of people, maybe not wanting to buy American or not want to fly to US, so regardless of the treaties and whatever arrangements come and go, a lot of people are going to take this very personal. What do you think about that?
Listen, we're backed by a Canadian family, and I was told that one of the members was shopping in a supermarket, picked up a American packaged goods, and was told by the person shopping next to them that they didn't know that there's a Canadian substitute for that. If you knew this guy, he wasn't shopping for a conversation. He didn't want the input from anybody else. But that is the mindset. And I think you're right. I don't think this has helped the US perceptions, but is it permanent or not? I think it's too soon to tell. And I wouldn't be, I actually, Mark, feel I'm kind of balanced that this is negative. I'm sending the wrong message because I do think there's a balance to this that's not all bad. And I think the US will be okay. I think we're due for a pullback in a recession anyway. I didn't think we needed to do it ourselves. I didn't think we need to be self-inflicted, but I don't think the policies are all wrong. I think the heavy-handedness is where I struggle with most. And I like it clarity.
Just this one, is that you, Mark, at 650?
You like more water?
If you're on your phone, you have to hit star six. It's our first soon. Andrew then.
Yeah, to David Lane's point and then Stephen's follow on. My son-in-law is Canadian, nothing to do with finance. At dinner on Sunday, he was just basically commenting, and his family is very low key. He said, everybody in Canada is very angry. We're not talking about politics. We're not talking about banks. We're not talking about financial people. He said they are just mad.
Americans that are really pissed off too, right? With all these protests going on across the country. I mean, that could snowball over the next couple of months, right?
Yeah, it's not the best look for the US by any stretch.
I lived abroad when the Hanging Chad came out, and it makes the Hanging Chad look good. Andrew Randak made a good point, but I don't know how long term this is. It's certainly it's at the moment.
Yep.
I get it.
Jim Carroll.
Yeah, Jim.
David, how are you?
Good, thank you. How are you?
Oh, excited.
What excites you, Jeff?
Volatility.
Okay.
One of the structural issues, some of this seems to me to be slow motion in the sense that, for example, if you have a pension plan in Europe, private banks in Europe, the place to be invested has been the United States. And to the extent that, and those are not necessarily fast moving dollars, but if we begin to see essentially a divestment from the United States back to Europe and or Asia, those flows are certainly not a positive for our equity markets. Do you have a view on that?
Yeah, I think that you will see that some of the Canadian pension plans have already started, the European pension plans have already started, but I go back to in the 80s, Canadians were only allowed to invest 15% of their money outside of Canada. So that gets a little limiting in what your investment choices are and makes you very risk reliant on a certain area. I think the size of the US capital markets is something that you have to keep in mind when they start talking about those divestment movements. It's a lot different to say you're going to divest South Africa, for example, when they did that for apartheid, as opposed to divesting from the US, which is, as high in a share of the global economy as we've been in some time, certainly the global equity markets. So I don't think I think it's an issue, but I don't think, there's $20 trillion roughly of European, 17 trillion of European equity investments in the US stock market. Some of that's going to go, but not all of it.
I think, unless there's something dire, compelling, we're going to call this a wrap. And thank you, everyone.
Wait, can I tell my long joke?
Oh,
It's not that long. There's two though.
if you want to stick around for a joke from Laura,
Two.
jokes, sorry. Do the short one first, maybe.
Okay, sure. Okay. Will you remember?
Yes.
Not all of you. Do you remember?
You have to all in unison.
Yes.
Come off mute. Will you remember Laura?
Yes.
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 Yes. Remember me in a second.
Yes.
Yes.
In a minute.
Yes.
In a week.
Yes.
Yes.
Knock knock.
Who's there?
Who's there?
You didn't remember me. Okay, this one. How do you put an elephant in a fridge?
How? How?
Open the fridge, put the elephant in, and close the fridge. How do you put a giraffe in the fridge? Open the fridge, the elephant out, put the giraffe in, and close the fridge. The alligator was hosting a party. Everyone went, but who?
I don't know.
The giraffe, because he's stuck in the fridge. Now, the little girl wanted to get across the river, but she was too scared because of the alligators. But she got across safely. How?
I don't know.
Because the alligators were at the party.
Hell of a party.
That's all you got? Okay. Thank you, everyone.
Goodbye.
Thank you, Laura.
Thank you. Have a great day.
Thanks, Laura. Thanks, Mark.
Peace out.
Yeah.
Peace out.
Bye, guys.
Well done, Laura. Your
Yeah,
debut.
great job.
Your re-debut.
Yeah, you made it all worthwhile.
Mark, I have to run, unfortunately. That was fascinating.
Oh.
Thank you.
Really good